Okay, so far it's just the two of us, it looks like. So maybe we'll wait a minute or two for other people to jump in. So yes, this is derivatives class. Yes. Now, what's great about this is that the session is being recorded. So that way, if anyone's late from work or something, you can watch the recording, or if you can't be here at all, it's all being recorded. I'll be posting it. Actually, I'm probably going to end up posting it on my YouTube account because we can run into space problems on Brightspace. Uh, mention it when everyone else gets here, but I do have a lot, and I mean a lot of files here from other classes on my YouTube account. So I do this all the time. There doesn't seem to be any limitations on how much storage I can have on YouTube. So I just keep using it. And so after tonight, I'll put that in here. I have to create a new playlist for this. And so let's see, let me just show you where you would find this. Um, my channel, you can see it's listed under Dr. ACA. And under the playlists, yeah, you can see those are all recordings. And so it's a lot. This is going back a few years. And so every so often I get emails from YouTube asking me if why I'm not doing more to monetize my channel. Well, that's not why it's here. So but yeah, I think it's just easy to put it here because I've had problems in the past where the videos do take up quite a bit of space. So if I try to put it into Brightspace, it would probably work, but I don't want to push my luck. Okay, so anyway, so this is the derivatives class. So I've opened up Brightspace for everyone to see. Now they've changed the procedure a little bit. Right now, if you can see over here, I put the slides. I do everything on PowerPoint slides. And so you'll see our notes for tonight are right here at week one. And there's a set of notes. If you download it, you'll have access to the slides. And also, most weeks, but not all weeks, there's a brief assignment that needs to be done. And so, for the first week, it's fairly straightforward, fairly short. But there'll be some weeks where we're doing our work in Excel. So I think if you should find that helpful for your work, because of course Excel is everywhere, and some weeks there's a lot of calculations, and it's not the kind of thing you want to do with a calculator. It's usually easier to do it with a an Excel spreadsheet. So anyway, so the big difference now, and they just changed it this year, is I used to put a syllabus in here, and now they insist on it being done a certain way. You come up here to more tools. You'll see right here it says syllabus. And so this is where you're going to find it. You won't find it listed separately. I think the reason why they're doing this is to make sure that it's exactly, and I mean exactly in the format that they want. So yeah, I had to send them copies back and forth and I had to make corrections. Now it appears to be in the form that they want. But this way, I guess they want to be able to see it as well as you. So I think you can still print it out if you need a copy. But what we should do is probably quickly go over some of the key details here. So here's the title of the course.
Hey, Alan, how did you
Yeah.
get to the syllabus again? It was under more
Oh,
tools?
right here. Okay. What you have to do is when you go into Brightspace,
Yeah,
beginning, when you go into homenyu.edu,
yeah.
go back even further. Once you hit homenyu.edu, you have to go to Brightspace. Now, I have mine set up so the Brightspace is on the front page. I don't know where yours is
Yeah,
located.
I've got this view right here. Yep.
Oh, okay. Once you get there, your courses should be over here on the left. And
Yep.
go to the top, across the top, and I had to look for it myself because they've just started doing this. Oh, actually, sorry, we have to be in the
Yeah,
course.
click in there. Yep.
And then run across here to more tools. And then
Yep.
way at the bottom is the syllabus.
Oh, yeah, I don't have that available in here.
You don't? Oh my God.
No, that our lists are our more tools are different, probably because you have more access.
Oh, that's interesting. I'll tell you why. Then I better send an email to the school tomorrow and say where I didn't even think about that. that yours might be different than mine because, of course, that makes sense. So, is anyone here able to find their syllabus? Okay, I'll make a note to myself to write to the school tomorrow about this. Yeah, that's very strange. Okay. You would like to think there'd be a link on the top that says syllabus, but I guess that would just be too easy. But anyway, once you do find, or maybe it's in a course reports, who knows? They specifically told me not to put one here with the notes. So I guess they're worried that it'll be different than what they wanted or something. Um, anyway, so let's just quickly run through it, and then I'll let you know as soon as they tell me where to find it. I'll send you an email, and you'll be able to find it. And so, a lot of it is just a description of the course, of course, and the dates. Now, here, for example, you notice that it runs for the next 8 weeks. It's synchronous, which means in principle we're meeting at the same time. But if you can't be here or if you're late or whatever, of course you can watch the recording, which for the people who just joined us, I usually store it in my YouTube account. But if there's enough room, I can also put it in Brightspace if that's more convenient for everyone. You don't have to watch the recording unless you miss something. But it's good to know that, like, if you're stuck at work and you're like, oh my God, I'm going to miss my class. Well, no, you're not because you can watch the recording. I used to work in the corporate world. I know how it is. It's the unpredictable part that's so aggravating. It's like fine, working a lot of hours, but if you can't tell in advance what night you'll be late, that's very frustrating. So here's my YouTube account, and I'll be creating a separate playlist just for us. And you can see I do have quite an inventory of others. These are all set to public so that if you, for some reason, decide that you'd like to look at my recordings for some other course, you can certainly feel free to do so. And that's not a problem. So, anyway, what else do you need to know? So you have my name and my email. That's my email for NYU, and so now, by the way, yes, if you office hours, we can't obviously have physical in-person office hours. If you really need to go over some things, you can send me an email and then we'll figure out a time that we're both free and we can have a Zoom session just like this one. I usually end up doing these Zoom sessions on Sundays, maybe depending on the weekend. It could be Sunday morning or Sunday night. So that way, if you're like really stuck, I don't understand what we're doing here, I want to go over these homework problems, we can do it that way. Okay. But I'm always available. It's just that it's usually going to end up having to be on the weekends. Sundays typically. I find that Sunday is my getting things done day anyway. Saturday is the only day where I just said, that's it, I'm having fun today. Sundays, it's all business. So anyway, what we're going to do in this class is we're going to look at the derivative securities markets. Now, this is an extremely important topic because derivatives are heavily used for hedging purposes, for reducing risk, but they also can be used for speculation or gambling. So these markets, some of them have been around for quite a while. Some of them are relatively new. And there actually is a book listed down here somewhere where a lot of this material is based on. Like, look at this thing. Here it is. Here it is. Let me show it to you in YouTube, by the way. I mean, sorry, Amazon. This book has been around for quite a while. It is absolutely the industry standard. As far as I know, it's still on the 11th edition. And but there's many, many different versions of it. So if you can find one that's slightly older, like the 10th or the 9th or whatever, and it saves you a lot of money, you can feel free to go ahead and get it because it doesn't change very much from one edition to the next. The core that we're using is not going to change. It's the standard basic material that we need to know. What tends to happen is he adds more chapters about progressively more esoteric securities and maybe introduces some case studies about things that have happened in the markets. But basically, this is what you're looking for here. Now, I see that the paperback version is only $42. That's not bad at all for such a big book. I mean, it's very long. There's got to be at least 35 chapters, and we're covering maybe 8 of them. So Hull is like the guru, the derivatives guru. And I actually did get to hear him at a press conference once, and he's a really terrific teacher too. So I'm sure he's done rather well with this book. So this is the one that we'll be basing all of our notes on. And let's see. So there's a list here of the assignments. There's actually only 5 of them. Some weeks it makes more sense than others to have an assignment. It's just based on that week's material. And so in most cases, you can sit there and do it with a calculator, or else you can use Excel, and we'll go over that as we go along. In some cases, I've created a template where a lot of the typing is already done for you, so to speak. So in others, you can just focus the on the formulas. Okay. So basically, what are we doing in this course? Well, we're going to look at the 4 basic types of derivatives, which are called forwards or forward contracts, futures or futures contracts, swaps, and options. And there are many other variations of these, but these are the 4 basic types. We want to understand how they can be used to hedge market risk, because after all, that's what they're for. That's the purpose of these derivatives, is to help market participants eliminate or reduce their risk. But there's nothing to stop people from using them to speculate. And we'll discuss that too as we go along. We'll show how for each security, how you might go about this. And along the way, we'll also throw in some historical anecdotes, usually not very pleasant ones, where some organization or some individual managed to lose enormous sums of money by misusing derivatives. Okay, it's easy to lose a lot of money in a hurry with derivatives if you don't know what you're doing. Okay, so you'll be sufficiently horrified when you see what's actually happened in some of these cases. So anyway, we're going to understand how derivatives are used for hedging purposes. Sometimes they're not appropriate. Sometimes there are other things we should do instead. Sometimes this is exactly what we need. Then we're also going to start delving into measuring the risk of derivatives. In other words, we want to understand exactly how they're reducing risk by explaining how sensitive they are to changes in market conditions. And we're also going to look at some trading strategies. And finally, we're going to question or learn about how the derivatives themselves are priced in the marketplace. And that, by the way, is where it gets very heavily mathematical. So we can do a pretty good job with just basic graphs, but we'll do some of the math in Excel, and you'll see that this is where the rocket science gets involved in the pricing of the derivatives. Okay, so it's all very interesting, very exciting, very important, and especially if you're working in areas like risk management or banking or investment banking, it's very important to have a good fundamental understanding of how derivatives work, because they're heavily used in every aspect of most businesses, and it's just interesting in its own for its own sake. So anyway, basically, for all practical purposes, the grade is just going to come from these assignments. We don't have time to have tests. We got 8 weeks. Okay, so we'll have these assignments, and that's how I'll grade you. And then, the rest of this is, policies and, but also they insisted that I put in a list of the chapters that we'll be covering and what weeks we'll be doing that. So this is the list. You can see they're all taken from Hull's book. And we're not necessarily going in the same order he is, but these are the ones that we'll be looking at. So if you want to read ahead, you can certainly feel free to do so. Okay. All right, that's enough of that. Let's go start looking at the notes. Is there anything else I missed? I don't think so. But all right, let's just do this. So all the notes are already posted, and you can read ahead as far as you want. If you would like to read what's coming up next week or the week after, you can do that. So we'll start by giving you a broad overview of the 4 basic types of derivatives, which I mentioned before: forwards or forward contracts, futures contracts, swaps, and options. Along the way, too, we'll discuss some of the more bizarre types of derivatives. Over time, these very simple products have evolved to some very complicated structures. And in those cases, we'll try to understand what they're used for. And then we're going to look at some very basic hedging strategies. And so we'll start by noting that the two main reasons one would want to own derivatives are either for hedging, eliminating risk, or speculation. Now, hedging, as you probably know, is what you're trying to do with hedging is you're trying to either reduce or eliminate the risk of some process, some activity that you're involved with. Here, we're specifically focused on the risk that you lose money with an investment of some kind. Or let's say you are doing business overseas and you want to hedge the risk that the dollar will depreciate or appreciate. There's a lot of ways in which we can hedge a risk with derivatives. Where speculation, you're doing the opposite. You're actually taking on risk. You're increasing the amount of risk you're exposed to because you believe that will increase the likelihood of having large profits. Okay, so with hedging, you're reducing risk. With speculation, you're increasing your risk. Now, they're very powerful, flexible hedging instruments. In fact, I should have sneaked this in here somewhere. Warren Buffett, the very great investor, once said, he had a couple of great quotes about derivatives. Let me see if I can find the direct quote here. Okay, yes. He called derivatives financial weapons of mass destruction. Okay, because of their potential to destroy an organization if they're not used correctly. And there have been several sad cases over the last 20, 30 years. And so he doesn't actually buy them, I believe, for like say Berkshire Hathaway, but because he doesn't believe that he understands them well enough to invest in them. You know, he's always had the strategy that I don't want to own anything that I don't understand it, which is a very sensible philosophy. What's great about derivatives, though, is that they give us more ways of hedging risk than you could other approaches to hedging risk that would be impossible with other types of securities. So in other words, they give us a lot of flexibility that you couldn't get with other securities that trade in the market. They're also heavily leveraged. Now, you know what that means. It means that you're putting up a relatively small amount of money in exchange for exposure to a lot of risk. So that means that small changes in market prices can have an enormous impact on the value of your derivatives. And that's how people end up losing money. They don't understand in a lot of cases how rapidly the prices of derivatives can change due to market conditions. Now, here's one of the case studies. I just want to briefly mention this one because this case was actually made into a movie, if you can believe that. This involves a bank called Barings, which doesn't exist anymore. The Barings Bank, it was a British bank that had been around since at least the 18th century. It was a very well-established bank. And it was so prestigious that the Queen had some of her money in this bank. And here's another interesting side note. You might recall from your history books that in 1803, Thomas Jefferson bought Louisiana from the French, specifically from Napoleon Bonaparte. You might also recall that he paid $15 million for Louisiana, which covered all the way from what we now call Louisiana up all the way up to the Canadian border. And so the problem was that the United States was still a very young country. It didn't have $15 million. So how did they raise the money? They had Barings Bank, they hired Barings Bank to issue bonds that would be sold to investors. And then the United States would pay the interest on those bonds. And so in other words, it was like one of the first leveraged buyouts, I guess. We bought Louisiana from Napoleon with borrowed money. Now, there used to be a really nice museum in the Wall Street district called the Museum of American Finance. And they had in their collection some bonds that were issued by Barings. And they actually had a bond that was signed by George Washington, as a matter of fact. But The building was destroyed by flooding, and so they're still looking around for a new home. But anyway, so here's Barings. They're doing just fine. And they decide one day, you know what, we really should have a presence in Southeast Asia. They decided it would be a smart move to start up a trading outfit in Singapore because they felt like, now, by the way, this is in the early mid 90s when a lot of derivatives trading is taking place and a lot of speculation is happening. And it appears that this is a very lucrative activity. So they don't want to miss out on this. So they chose this trader named Nicholas Leeson to go out to Singapore and start up a branch and say, listen, Nick, go out there and start up a trading outfit in Singapore. We need this. So they sent him out there. And here was the critical mistake they made. He was in charge of both the front and the back office. Now, if you're not familiar with this, the back office is where they keep track of all the records. The front office is where the trading takes place. So what happens when you put the same person in charge of both? Well, then he has the ability to hide his losses, and that's exactly what happened. He didn't. Here's what he did. Now, in a way, he was unlucky. This is around 97, I believe. He thought he understood how derivatives work. And so he decided to take a bet on the Nikkei 225, which is the Japanese stock market, the main Japanese stock market index. It's basically their Dow Jones. And so he figured, well, it's Japan, the economy's booming, nothing can go wrong. I'll buy futures contracts on the Nikkei 225. And if the Japanese economy does well, I'll clean up. Sadly for Nick, around the same time, there was a massive earthquake in Japan, and the Nikkei 225 plunged. So you figure, all right, well, he wasn't lucky. He chose the worst possible time to get involved with Japanese stocks. So being Nick Leeson, instead of selling his position and moving on to something else, he decided, you know what? I'm still right about this. My timing just wasn't good. So he goes ahead and he does the same thing. He actually increases his bet on the Japanese stock market. And that's when things started to go wrong because his losses started to pile up and pile up and pile up. And eventually it got to the point where he couldn't cover his losses anymore. Now, he also defrauded Barings by lying to them about what he was doing, but he also forged documents to convince Barings to send him more money that he could use to gamble on Nikkei 225 futures. So when all this was over, he eventually did actually some jail time. And not because of his losses, but because of the fraud that he committed. So this is one of those cases, you don't see this a lot. Many of these cases where traders lose enormous amounts of money, they don't go to jail, they just get fired, maybe sued. But this is kind of unusual. He actually did spend 3 years in a jail in Germany. And so that's the sad story. Now, of course, in the meantime, Barings lost all their money and they went bankrupt. So that's why it doesn't exist anymore. This one guy managed to lose $1 billion in trading, and that wiped out the bank's capital. $1 billion. And it was only over a matter of a few months. So that just shows you it's a cautionary tale as to what can go wrong with derivatives markets. The movie, if you're interested, is called Rogue Trader. It's actually a very good movie. The lead character is Nick Leeson is played by Ewan McGregor, if you know him. And so it was very well done. By now, this movie's been out for a while. You could probably go get a free copy somewhere, but you might want to check it out. It's actually very well done. What's good about it is that, unlike a lot of these financial movies that you might see, they actually did a good job keeping all the details accurate. So yeah, anyway, it might be worth your while to check it out. All right, here we go. So derivatives. Now, a derivative security is a financial asset whose value is derived from some underlying security. That's where the word derivatives comes from. Some underlying security, possibly a stock or a bond. It could also be the price of a commodity like gold or silver or oil. It could also be an agricultural commodity like corn or wheat. It can also be based on interest rates or stock indexes. Now, believe it or not, it's actually possible to buy derivatives based on the weather. In other words, you can actually buy a derivative whose payoff depends on whether it rains a certain amount or whether the temperature reaches a certain level. So pretty much anything you need or want to be hedged, you can do this in the derivatives markets. Whatever you need, it's out there somewhere. Somebody's willing to sell you one of these products. They're out there. You just have to go ask around, go to an investment bank or something, and pretty much anything you need, it's out there. Now, what's interesting about this, unlike some other securities like stocks are traded through organized exchanges for the most part, although the smaller ones, the penny stocks, are traded directly between brokers in the over-the-counter market. The same thing is true with derivatives. Some of them are traded over organized exchanges. Some of them are done directly through between counterparties. So in the United States, the most important of all the derivatives exchanges is whoops, the Chicago Mercantile Exchange. Okay. Now, before we go any further, I want you to see this. They have their own website. All right. Here we go. All right. And here it is. This is the Chicago Mercantile Exchange's website. And you'll notice that there's a lot of information here. It has information about the products that they trade, and you notice that derivatives are available there based on anything you could imagine, like agriculture, cryptocurrencies, energy, equity indexes, foreign exchange, interest rates, metals, you name it, they've got it here somewhere. They There's all kinds of information here about things they can do for you, but here's something that you might want to pay attention to. They also have a lot of free training materials for people who want to learn more about derivatives. They have all these courses that you can take that are completely free. And so you can see there's all kinds of them. In fact, I think you can even get a certificate from them if you pass enough of these courses. So, if you find that you find this course very interesting, you may want to get more deeply involved with it. And this would be a good way to get started by going through and learning from the Chicago Mercantile Exchange, which is, of course, the biggest derivatives exchange in the country. It may even be the biggest in the world. So, we'll be coming back to this website from time to time and seeing what kind of products they offer and learning more about their features. But yes, it's all here for anyone who wants it. Wow. Okay. We also have the New York Mercantile Exchange, although they primarily focus on energy derivatives. It's not a very big outfit. Let's see what their website looks like. Oh, I forgot. Whoops, they were bought out by the CME. So yeah, they have energy. They're always known for their energy derivatives, but they also have metals and agricultural contracts. So, in other words, if you notice, the Chicago Mercantile Exchange, they do have some agricultural derivatives, but primarily they deal in what we would call financial derivatives. But here, if you need, let's say, energy derivatives, agriculture, let's say you're a farmer, you can hedge the risk that your crop prices will fall by the time your crop comes to market, or metals. And it's not just gold and silver. They also have derivatives on industrial metals like copper and zinc and nickel and that type of thing. So, wherever there's a demand for hedging, there's going to be a security that you can buy uh, available through one of these exchanges. Now, in London, the big derivatives exchange is the London International Financial Futures Exchange, or LIFE, it's sometimes called. I'm trying to find their website. They may also have Training materials. Well, yeah, this would be information about the products that they sell, but I don't know. This doesn't look that great. Let's see, what else do they have here? Anyway, but just remember the CME has all that wonderful learning content. Now, derivatives that are negotiated directly between counterparties are often said to trade on the over-the-counter market or the OTC market. So in the United States, penny stocks trade this way. So if I want to get the stock of a very small company that's too small to trade on the New York Stock Exchange, let's say, I'll have a broker, I'll call up a broker, and he'll call other brokers and negotiate a trade. Okay. So I don't know if you've ever heard this terminology or not. Penny stocks, they are small companies with very low stock prices, and they're corporations, but they're usually just too small to trade on a full large exchange like the New York Stock Exchange. Yeah, I was hoping to get a brief discussion about what they are, but that's really all it means. It means they're very small companies, and their prices could be like less than $1. But the rest will be traded over an exchange. Now, if you want to know where a stock trades, like for example, let's say I'm interested in knowing where does Apple trade? You can ask you can ask that question too, but you can ask for Apple's ticker symbol. Now, this is the symbol where it trades, it is recognized in the marketplace. So here you can see Apple's ticker symbol is AAPL, and they trade on the NASDAQ. Okay. The NASDAQ is where you tend to find the high tech companies. Um, New York Stock Exchange is for the more well established companies, although Apple is a pretty well established company these days. Um, but if you're interested in finding out, this is one way you can do that. By the way, if you're really want to research a stock's price, Yahoo does have this available, finance.yahoo.com. AAPL would be Apple. See, here's the recent chart. Let's say I want to go back a year to date. You can see what's been going on with Apple, or just the last 12 months. Well, look at this. I think we missed a golden opportunity here. From last year at 181.56 to 245.70. It's a pretty big jump. So any stock you're interested in, as long as it's publicly traded, you should be able to find it here. I mean, as long as it's on an exchange. I don't think you'll find penny stocks here, but you never know. Anyway, so again, the four basic types, we're going to look at these one at a time now: forward contracts, futures contracts, swaps, and options. What we really want to know is how they're structured, what are they used for, and what are their advantages and disadvantages. All right, so forward contract is an agreement. It's just a contract or an agreement to buy or sell an asset at a specified date in the future where the price is agreed on today. So it's nothing terribly sophisticated. Let's say oh, here's an example right here. Let's say that you are doing business in England. Your company does a lot of business. You buy British products, you sell British products. And so you look in the Wall Street Journal and you see some interesting numbers. Now, these numbers are a little bit outdated, as you can tell. The pound isn't worth nearly this much right now, but let's say that this is the current exchange rate between the dollar and the pound. That number, by the way, is often called a spot exchange rate. And that means this is the price for buying or selling pounds for immediate delivery. So in other words, if you're going to get on a plane to London and you need some pounds in your wallet, this is the price you'll pay for them. But then all of a sudden you notice there's another quote here, 6-month forward exchange rate. What does that mean? Well, it means that if you don't need the pounds for 6 months, let's say you're in business of some kind, and you know that in 6 months you'll need to buy pounds to invest in some new business or other. So this is saying if I want to buy pounds in 6 months, where the price is determined today, I can enter into a forward contract where I agree that in 6 months I'll pay 167.15 per pound. Okay, so this is called the forward exchange rate, or in this case, a 6-month forward exchange rate. And you notice the two of them are not equal to each other. They usually are not. Now, later on, we'll see that what really determines this relationship is the interest rates in the two countries. All right, we'll get back to that later on, though. So there's typically forward exchange rates available for standard maturities like 1, 3, and 6 months. But in principle, we can negotiate any time frame that we need. Okay, so the key here is that I can eliminate all the risk associated with buying pounds in 6 months at a price of 167.15. Okay, I lock it in. I have a contract. I can buy the pounds for 167.15, no matter what happens in the market. Now, the good thing about this is that if the price goes up, I don't have to pay a higher price. But if the price goes down, I don't have the opportunity to save money. Okay, I'm locked in at 167.15. All right. Now, by the way, you know how the foreign exchange markets are a dealer market. You may have, if you've traveled, for example, let's say you do need to go to London on business, and you go up to a dealer. Now in Manhattan, there's a lot of banks that will deal in foreign exchange, especially there's something about the area right around the library, the public library. There's banks all over the place that'll buy and sell foreign currencies. And if you ever looked at those signs very closely, you'll see that there's always two numbers there, right? So why are there two numbers? Well, they have the first lower number is the bid price, and the higher one is the ask price. So what is that all about? So the dealer who's giving you these quotes is saying, listen, I will buy pounds from you at $1.32. I will sell them to you for $1.42. So that means the dealer is making 10 cents on each transaction, or each pound for each transaction. This is how they make their money, okay? By gaining the difference between the two. And the spread between the two the 10 cents is the source of their profits. It's called the bid ask spread. Okay, so that's the bid ask spread. Now, the size of the spread will depend on the size of your transaction. So if you and I go up to the window and say, I need 100 pounds, the bid ask spread will be quite wide, okay? Because they're never going to see you again. This is the last chance they have to make money from you. So they're going to get the bid ask spread as wide as possible. But if you're buying 1,000,000 pounds, let's say you're a huge corporation, then the bid ask spread will be much smaller. It could be less than it could be a penny even, because the dealer is still making a lot of money because you're multiplying that bid ask spread by 1,000,000 pounds. So the size of this bid ask spread is determined by the size of the transaction. So when you look at sources like the Wall Street Journal or Bloomberg for exchange rates, like for example here, oh, let's take a look at today's quotes. Like just right here, it's a simple one. This tells me that at the moment I need to buy or pay $1.05, 105.02 to get a single euro. That's not actually a traded price. That is the center or midpoint of the bid ask price. Okay, so that's the average of the two. It could be like 103 up to 108 or whatever it happens to be, but the bid-ask spread, the center of that is the number you see here. So a lot of interesting quotes here, but these are spot exchange rates. I don't think Bloomberg's has forward exchange rates. Okay.
Sorry, are you sharing your screen on something?
Yeah. Are you seeing what I'm doing?
I Yeah, I can only see you right now. I don't know if anyone else is having that issue. I only see the
Oh,
videos.
oh, no kidding. You're not seeing the slides?
I am not right now.
Oh, oh boy. You know what? This is bad. I don't know
I
very
can
much
see
about.
them.
You can see the
Maybe it's the
screen?
view that you're selected. Maybe go to view
Oh,
at the top of the screen and see
um,
if you can adjust it to where you can see it.
oh
The way
yes, sorry,
you got it?
my mistake.
Okay.
Thank you.
Oh, that's good
You're
because
welcome.
I don't know anything about the technology. I'm glad somebody in the class does. Thank you. But and like I said, I mean, if you want to, if you missed anything, you can go back and watch the recording later on. And it'll be up there like forever. Once I put it in my YouTube account, it never disappears. It's not like, some places where they say, oh, the recording will be there, but it disappears after a while. Okay. But yes, so for like £1 million transaction, look how small this bid-ask spread is. It's less than a penny. And that's because you're multiplying that by £1 million. And so even with such a small bid-ask spread, you're looking at a $2,000. Okay. Now, like penny stocks, forward contracts trade in the over-the-counter market, meaning that you're not buying it on an exchange, you're getting it from probably an investment bank. Okay, so in other words, if you're a business that does, you have a branch in London, let's say, and you're constantly needing to buy and sell pounds, and you have decided to enter into a forward contract on the pound, you can probably get it from any bank in England, or you can get it here. And typically, it would be the investment banks like Goldman Sachs and J.P. Morgan Chase that would enter into this contract with you. Okay, because they have the resources to do this properly, and they're also, when you enter into this contract, they are actually taking on some risk. Okay, so that's why you will probably do this directly with a large investment bank as opposed to an exchange. Now, the beauty of that is that I can customize that contract any way I like. Okay, so let's say, for example, I'm doing business. Let me just add this here. For example, a U.S. firm that does business in Iceland and enter into a contract to buy Icelandic kroner at a specified price in the future. The quantity, time of delivery, and asset can all be customized. So, in other words, if you can find another bank who's willing to take the other side of this contract, let's say a bank that is maybe located in Iceland, and you say, listen, I want 12,000 kroner in 37 days, something ridiculous like that. It's not a problem. If you can find somebody else who will agree to that, you're good. It's completely between you and the other counterparty, what you agree to do. And that gives us a lot of flexibility. Okay. So forward contracts are hugely popular. And in fact, in the foreign exchange market alone, there's something like I think it's $2 trillion worth of these contracts are entered into every single day. So that shows you how important these are as a source of or a way of hedging our risk. Okay. Oops. Now, here's some important terminology. if you are entering into the contract to buy the asset, you're said to have a long forward position. If you're entering into the contract to sell, you're said to have a short forward position. Okay, we'll see those terms again as we go along. Long normally means you're buying something or you already own something, and short means you're selling it or you have to repay it at some point. So how are we going to use these contracts to hedge our risk? So again, let's stick with the example of foreign exchange. Let's say, by the way, we need to do a little bit of review here. Let's say that at the moment, the exchange rate between the dollar and the pound is $1.30 per pound. And then suddenly it jumps up to $1.35 per pound. Well, one of those currencies just got stronger and which became weaker. So the way to think about it is, unless somebody wants to go ahead and volunteer, which currency got stronger?
The pound got stronger.
That's right. And then the dollar got weaker for the simple reason that it now takes more dollars to buy a pound. So the correct terminology here is that the pound is depreciated against the pound and the pound is appreciated against the dollar. Now, this could be a real problem if you were planning on buying pounds in the future as an American company, because now they're all going to cost you more than they otherwise would have. So if you're an importer, for example, of British goods, and you're expecting to need 100,000 pounds worth of goods in 6 months, the thing that keeps you up at night worrying is that the exchange rate will go up, meaning we'll have a weaker dollar. And here's numerically, if that does happen, this company will pay 5,000 more dollars for those pounds than they should have. So that's why they're worried about this. But on the other hand, we can eliminate this risk by entering into a forward contract, because then we've locked in the price that we'll pay in the future. Now, of course, if it drops, if the dollar gets stronger, then the price of the pounds will go down. So the American company is well aware of this, but they don't want to take any chances. So they may decide to enter into a forward contract to buy pounds in 6 months. Okay, so this would be their motivation for doing this. All right, so let's face it, most companies don't have a lot of expertise in the foreign exchange markets. So, they're not going to sit there and say, well, I'm pretty sure the pound will get weaker. What's the big deal? No, they just want to get rid of the risk and not have to worry about it. Now, let's just say that in this case, it's possible to buy pounds for forward delivery at $1.32. That means that in 6 months, no matter what happens, you're going to pay $132,000 for those pounds. So you eliminate the possibility of paying more, but you also eliminate the possibility of paying less. So you're locking in a price. That's it. You're done. Now, this graph is going to show you, like, let's say the exchange rate is $1.70. The point of this graph is to show you that if you hedge your position, if your forward exchange rate is 170 per pound, then for 100,000 pounds, the hedge position is never going to change. The straight line represents paying 170,000 regardless of the market price of the pound. Whereas if you hedge, or sorry, don't hedge, then this diagonal line shows me how much I'll have to pay for those pounds at every possible exchange rate. And if you notice, as the dollar keeps getting weaker, the pound becomes more expensive and I have to pay more for my pounds. So, and if that keeps happening, I'm going to start being sorry that I didn't hedge my risk with a forward contract. Now, by the way, here's an interesting side note. If I am not doing business in England, but I just think that the exchange rate is going up, let's say I do enter into this contract. If in 6 months the exchange rate is more than $1.32 a pound, I can then buy them at the lower price of 132 and sell them at the higher market price and make a speculative profit. So, so hedging the risk of a price increase would be done with a long forward position, which means that if I'm worried about the price going down, then instead I would take a short forward position. because I'm now trying to sell those pounds and I don't want the price to go down. So I can eliminate that risk by entering into a short forward position. So just to summarize that, to hedge the risk of buying an asset in the future, we enter into a long forward contract. To hedge the risk of selling an asset in the future, we enter into a short forward contract. But also, I think I'll add this too. To hedge, to speculate on the price of an asset rising in the future, enter into a long forward contract. Meaning that, and when I say to speculate, it means if the price goes up, you'll make money this way. Okay. To speculate on the price falling in the future, enter into a short forward contract, meaning you're agreeing to sell. That way you will benefit from it when the price does go down. Okay. So the way to think about it is that in the forward markets, what you're doing is you are agreeing to do something in the future that you want to do today. Or I'm sorry, to enter the contract today for something you need to do in the future. Okay. Now, with all that being said, forward contracts, as we've seen, trade in the over-the-counter market. That means that it's generally difficult to get prices for them. So now the second major category of derivatives is the so-called futures contracts. Now, in a lot of ways, futures contracts are the same as forward contracts, but there's some very, very important differences. Like what? Well, as we've just seen, forward contracts are negotiated directly between counterparties in the over-the-counter market. But futures contracts are traded on exchanges like the CME. So that's one of the big differences. So if I want a futures contract, it's going to come from a place like the CME. A forward contract, I'd have to go out and find an investment bank who's willing to sell it to me. Of course, as you can imagine, there's some good things about this and bad things. So like what would be some of those things? A forward contract, because it's negotiated with a counterparty, there's always a credit risk involved, meaning there's a possibility that your counterparty could default on their side of the agreement. All right, that's one thing you have to watch out for. You figure, wow, oh, I'm doing business with a major financial institution here. Well, what if people said that just before Lehman Brothers failed? I'm sure they had a lot of forward contracts that were never honored because they were gone by then. It happens. It does happen. Not often, but it does happen. The futures contracts are completely safe because they're all guaranteed by the exchange. Okay. You can't lose money unless the exchange goes out of business, which is not going to happen. All right. So that's one of the good things. This is like if you were to make up a little checklist of things that are good about forwards and goods about futures, this one is advantage futures contracts. Okay. Now here's an interesting twist. This is something that's unique to the futures markets. What if I do enter into a forward contract to buy, let's say, gold in 6 months? And I've negotiated, let's say, a price of $2,000 an ounce. In 6 months, what if it turns out I don't actually need the gold after all? Well, unless the counterparty can be persuaded to drop the whole contract, I'm stuck buying the gold at the price that I agreed to. It's a legally binding agreement. End of story. I have to do what I agreed to do. Otherwise, I'll end up in court. A futures contract actually technically is the same, except we have the ability to do something called offset. So here's a good example. An investor enters into December gold futures contract on the Chicago Mercantile Exchange to buy 100 ounces of gold. And then suddenly something happens and he doesn't need the gold. He can offset that by taking the exact opposite position in the same contract, meaning he can take a short position in the same December gold futures contract to sell 100 ounces of gold. What does that accomplish? It means the cash flows from the two positions exactly offset each other. And so I end up having a net position of 0 with respect to the gold market. So in effect, I've gotten out of my position, but I didn't have to pay any penalties or anything like that. I didn't have to break the law. I didn't have to break my contract. All I did was take the opposite position in the same contract, and that's it. I'm done. I don't have to worry about it anymore. Yes, go ahead.
Is there a time limit on that, or can you do it at any point within the contract length?
Yes, you can do this anytime. There might be some restrictions at the end. There's a date on which you're supposed to tell the other counterparty that you really are ready to take delivery. It's like the last 2 days or so. So there is some limitation on this, but it's very loose. You can just typically wait until the last couple of days before you announce that, that's it. I'm getting out of this position. So it's very, very flexible.
Does the value of the futures contract change in between then? So if you bought it
It can.
today and then you went to sell it a week from now, you could be selling it at a loss potentially.
Right. That's exactly right. Or you could sell it at a profit.
Right.
So in other words, one of the reasons why you might want to do this is because let's say this investor doesn't really, let's say you don't really want to buy the gold. You're not in the business of producing gold jewelry or anything like that. You're not a manufacturer, but you think the price of the gold is going to go up. So what's happening here is that when you get out of this position, if the price of gold has gone up, you actually are putting money in your pocket. So that may have been your motivation in the first place to gamble on the future direction of gold without ever actually touching the gold. So you can just say, well, listen, I'll enter into a futures contract rather, and I'll hope for the best. As soon as the price starts to go up, I offset my position, collect my profits, and I'm done. So it's easy with futures contracts. It's not usually even possible with forward contracts. Now, one of the interesting consequences of this is that if you really are just hedging the price and you really are involved in this market, you really want to buy the gold or sell the gold, then you may be better off with a forward contract. If you only want to hedge the risk without actually taking delivery, then you'd be much better off with a futures contract. So studies have shown that because it's so easy to unwind these contracts, only about 2% of all futures contracts actually result in delivery of the asset. The other 98% are offset this way. So if you really want to hedge but don't want to actually take delivery, then you have to do a futures contract. Okay. So then finally, there's this very interesting requirement with futures contracts. Because the exchange is guaranteeing the performance of your contract, they're at risk that you're going to walk away from your position and leave them holding the bag on your losses. So they require you to put money in a special account called a margin account, which is basically a type of collateral. And you put your money there. And yeah, you can go to the Chicago Mercantile Exchange and find out how much is required. It's actually a surprisingly small percentage. I'm not sure if we can find out. We should probably hold on one second. Okay, so let's say this contract here, COMEX 100 gold futures. Now, this contract is actually written on 100 ounces of gold. And let's say that let's assume that the futures price is $2,000. So that means that the contract actually gives you the right to buy 100 ounces at 2,000 each. That means we're looking at $200,000 worth of gold. The contract is actually written on $200,000 worth of gold, but the margin requirement is only $12,500. And that percentage is less than 1%, about 0.625% of the total. Now, you're probably wondering, well, are they crazy? Why are they allowing you to get away with such a small amount of collateral? Okay, well, that's a good question. Like if you buy a car, the car itself is the collateral for the bank loan. So it's like pretty much, if you don't pay, you're really in trouble because you're going to lose the whole car. So what's happening here is that as far as they're concerned, what they do is at the end of each day, they reprice or revalue your position. So let's say that you put $12,500 in your account. And the contract is written on 100 ounces of gold. So this way, if the price of gold goes up by $1, you just made $100. If the price goes down by $1, you lose $100. So at the end of each day, they have a committee that gets together and they determine exactly how much is in your position here based on trading during the day. So if at the end of the trading day, your let's say gold falls by $5, that means your position is now only worth $12,000 because you just lost $500. So the balance in your account is now reduced to $12,000. Now, the next day, if the price drops again, you'll lose even more money. And so what'll happen is eventually when your balance falls below a certain level, they'll call you up and say, listen, you've got to put more money into this account because you're getting too risky for us here. And that's known as a margin call. So they won't just let it go to zero. Now, the reason why they're doing this is because when the day is over, if they call you up and say, listen, you need to deposit more money in your margin account, and if you don't have the money, they just close out your position. End of story. And so that way, in principle, they're only exposed to the risk of one day's trading losses for each account. So this number reflects what they think is probably the upper limit on how much a single trader might lose in a single trading day. So they're willing to take the chance that nobody's going to lose more than $12,500 in a single trading day. Now, they might be wrong about that, but that's why the amount is so small, because it represents the potential trading loss for one trading day. So I think I have a simple example here. Yeah. So this one is a different contract. 5,500 is the initial margin, and then the maintenance margin is 5,000. So you have to start with 5,500, and your balance may not fall below 5,000. If it does, you'll have to put more money in that account. By the way, on the other side, if you make money, you can withdraw the surplus. Okay, so let's say the price goes up and you make $1,000. As long as your balance doesn't fall below 5,000, you can have it. So, and also the margin itself can be in the form of treasury bills. So you can still earn interest while the money is sitting there. But you can see that this contract is very heavily leveraged. Each $1 change in the price of gold is affecting your position by $100. So this could be a good way to just gamble on the price of gold. Because if you're right, your rate of return will be quite high compared to owning the gold itself. All right. So this is one of the things that makes futures contracts so exciting for speculators, the leverage. Okay, the fact that you can make so much money if you're right about the future direction of the asset. But unfortunately, you could also get wiped out if you're not careful. All right. So by the way, this process is known as marking to market. So in a nutshell, I mean, I guess if we were just to make up a list of pros and cons, just real fast. We'll get back to this in the next chapter, by the way. For a futures contract, the pros are flexibility in with offsetting a position. Okay, in other words, you can get out of it pretty easily. Delivery, taking or making delivery of the underlying asset. It's not necessary. And for all practical purposes, there's no credit risk. Okay. I'll just put this over here. So those are some of the very big advantages to these contracts. All right. Now, one of the drawbacks are with futures contracts, the cons include the need to keep funds in a margin account. That's a big drawback. And something else we haven't really covered yet, but lack of flexibility in the choice of underlying asset. Quantity of the asset and delivery. So what in the world do we mean by that? Well, so like if you can go back and look at the Chicago Mercantile Exchange page, but for any given asset, such as gold, there will only be single quantity available, which in this case is 100 ounces. There will typically be a small number of delivery dates available. So if you really mean to buy the gold for this contract, you've got to usually choose between March, there'll be a cycle, they call them cycles, March, June, September, and December. And I believe, if I'm not mistaken, it's the third Wednesday of that month or something like that. So in other words, you might look in there and say, well, I need delivery in August. Well, maybe they don't have it. Okay, so there's only certain delivery dates that are available for these contracts. There's only certain quantities. Like if I only want to hedge 20 ounces of gold, well, they don't have that. They only have 100 ounces. That's it. Each contract is for 100. If that's not what you want, then you probably should do something else, like a forward contract. So the quantity itself, there's a limited number of quantities, in this case one, and there's also a limited number of delivery dates. And also, there are only a small number of assets that can be bought or sold through futures contracts. Right. So in other words, if you look at the currency markets, only the major currency pairs are available. Like, in fact, we probably should be able to find out what currencies can be bought through CME futures contracts. Oh man, my computer's been slow today. And you'll see it'll be the British pound, the Japanese yen, the Canadian dollar, the Australian dollar, and some of the others. But if you're doing business, let's say in South America, and you need Brazilian, well, actually, they may have Brazil. Um, let's see if they've got a list here for us. But Iceland, no Iceland. That example I used earlier. Oh boy. Well, this is not really what I wanted. Oh, wait. Okay, here we go. Now this is something relatively new. These are smaller contracts that they've recently introduced. So you don't have to buy such enormous quantities of the currency if you don't need them. And oh, here we go. You've got dollar euro, dollar Australian dollar, dollar pound. But you can see, like British pounds, the normal contract is written on 62,500 pounds. That's a lot of pounds, especially for a small business. But this micro contract only requires you to buy or sell 6,250 pounds. In other words, 1/10 of the full amount. But still, what if I only need 4,000 pounds? Or if I need 8,000 pounds? I have to take what they have available. Okay, so in other words, what they actually have there is a situation where they have a fairly small number of contracts, but with enormous trading volumes. And that's done deliberately. The reason why they have so few contracts is so that the volume of trading is higher, because that's how they make their money, with volume. And also the volume is what makes it possible to offset a contract. Right. In other words, if I want to offset a gold contract, there better be somebody else out there who has the opposite position. Otherwise, I can't do this. So anyway, yeah. So in other words, what I'm trying to get at here is that forward contracts are far more flexible than futures contracts. Okay. Any feature such as asset, underlying asset, time to delivery date, and quantity can be customized to the needs of the investor. Okay. Anything you want, they've got it in forward contracts. As long as you can find a counterparty, you're good. Let's see. So that's really the cons, the funds in the margin account, the lack of flexibility. Positive would be offset. Actually, I probably should change this. The possibility of offsetting a position, but the ease would even be better. I think I like that wording a lot better. Taking or making delivery of the asset is not necessary. There's no credit or default risk. But we also have to worry about keeping funds in a margin account and the lack of flexibility. Forward contracts are far more flexible, and forward contracts also do not require a margin. But they cannot be easily offset and do expose the investor to credit risk. So you have to decide as the hedger or investor or the speculator, whatever the case may be, which of these two makes the most sense. Now, for some situations, the futures contract is the better way to go. For some, it's the forward contract. That's why both of these markets are so heavily traded. There's so much trading volume in both forwards and futures. Otherwise, one of them would disappear if one of them was clearly superior to the other. Okay. Now, swaps. The third one is swaps. Now, this is a very new idea in the financial markets, the notion of swaps. And in fact, they came into being almost purely by accident. The first swaps took place in the early 80s and not on Wall Street, as you would probably guess. This is a very interesting situation where I know that the two parties involved were the World Bank and IBM. And I don't remember all the exact details, but IBM apparently needed to get their hands on some currency or other. And for some reason, they weren't allowed to buy them directly. But the World Bank, let me see, I forgot. Let me see if we can find this story real fast. It's pretty interesting. Um, all right, so we have here, slide this over. Oh, I think we're going to see a video here that I didn't ask for. That's good. All right, here we go. There it is. IBM and the World Bank entered into the first formalized swap in 1981. The World Bank needed to borrow German marks and Swiss francs to finance its operations, but the governments in those countries prohibited it from borrowing. Wow, that seems bizarre. Why would you stop the World Bank from borrowing your currency? And then IBM needed a currency that for some reason they had trouble getting a hold of. So they basically said, listen, why don't we do this? Why don't we borrow the currency that we can get our hands on and trade it with each other because we have each other's preferred currencies now. And so what basically happened was it became clear, I guess word got around, and on Wall Street, traders said, this is a great idea. And they suddenly started offering their clients these swaps. And primarily, in the early days at least, they were either interest rate swaps or currency swaps. Now, at this point in time, there's any number of swaps, as you can imagine. I mean, the market has absolutely exploded because they're so powerful and flexible. You can see some of them were actually motivated in the 70s before that to get around government regulations, basically. It used to be that governments would stop people from buying certain currencies. It's very strange to think about it now, but there were rules about what currencies people could buy or sell. And so in order to get around those rules, there would be swaps taking place between different counterparties. And also some of this came about through taxes. In fact, there's all kinds of a lot of innovations have come about throughout history to avoid taxes. Okay. In fact, there exists something called tax arbitrage where companies try to figure out strategies that will help them save money. But anyway, these are over-the-counter products for the most part, but or at least they were initially. So the basic types are interest rate, exchange rates. We also have equity swaps and commodity swaps. And of course, there's so many others as well. What is the point of a swap? Well, we have two counterparties getting together and say, listen, I have something that you want and you have something I want, but we don't want to sell what this is. Let's do this. Let's trade cash flows based on the values of these assets. Okay. So here's a simple example. A basic interest rate swap based on the difference between what's called a fixed rate and a floating rate of interest. So let's just quickly go through that. What exactly does this mean? Well, a fixed rate of interest, as the name suggests, is set for the lifetime of a contract, let's say. For example, if an investor buys a 30-year treasury bond with a coupon of 8% per year, or let's say 3% per year, that doesn't change. For the next 30 years, 3% of the face or notional amount, and that often doesn't have to be each year for the next 30 years, followed by repayment of the face value. Because when you buy a bond like this, you're actually lending money to somebody. So if you buy a treasury bond, you're actually lending money to the treasury to help them cover their deficits. So you imagine you're plunking down $1,000 for this treasury bond, and in exchange for that, you're going to get $30 back every year for the next 30 years. And at the end of the 30 years, you'll get your $1,000 back. So this is what we would call a fixed rate bond because it never changes. So this one, it's exactly what you'd expect. But what can happen sometimes is some bonds or some securities have a rate of interest the coupon interest payment changes every year, can change, let's say every year. Typically it's every year, but periodically. These are known as floating rate bonds. So in other words, you can have to visualize, let's say imagine that here's a bond. And let's say you buy the bond today. Zero, by the way, represents today. And so the coupon is equal to, let's say, the prime rate in the marketplace. Then actually, I better be specific. It's the 1-year prime rate. I look in the Wall Street Journal, I see the 1-year prime rate is, let's say, 5%, let's say. And that applies for the first year. And then a year from now, the coupon, still the 1-year, the current 1-year prime rate, whatever it is now, let's say it's going up to 6%. So over the next year, the rate of interest is 6%. Okay, so in other words, every year, the coupon rate is changed or reset. And so this is known as a floating rate bond. And this carries on until the maturity date of the bond. And you might have heard of, with mortgages, for example, usually the rate is fixed for 15 or 30 years, but you do find these adjustable rate mortgages where every year the bank resets it. It's the same idea. Okay. So these are not that common, by the way, compared to fixed rate bonds. Normally it's just some fixed amount. You might not want to buy one of these unless you're pretty seriously convinced that rates are heading up in the future, because that way you'll have more income as years go by. But they do exist, although they're very specialized. You don't see a lot of people buying them, but they do have them. So here's a situation where a bank in its investment portfolio owns a fixed rate bond and an insurance company that has a floating rate bond. Now, let's just say they both have the same face value, which is $1 million. That makes it so much easier. The bank thinks that rates are heading up, and they wish they had bought a floating rate bond in the first place. I'm sorry, got it backwards. They think that, actually, no, I said it right the first time. They start with a fixed rate bond, and they start to think, if only we'd bought that floating rate bond, we think rates are heading up. And then the insurance company is the other way around. Okay. What they can do is, rather than sell those bonds and buy a new one, they can trade the cash flows with each other. So let me show you a little chart to show how that would work. Let's say the bank owns the fixed rate bond, and the interest payments are 5% every year, regardless of what happens in the market. The insurance company's floating rate payments are shown here. If they agree to trade cash flows with each other, that means the bank is paying a fixed rate to the insurance company, and the insurance company is paying the floating rate back to the bank. So in year one, they trade actually the difference between the two. That means here the bank owes 2% to the insurance company because the floating rate is very low. But then the next year, the floating rate jumps up to 6, and now the shoe's on the other foot. The insurance company has to pay 1% back to the bank. In the third year, the interest rate is the same for both. No payment takes place. In the fourth year, we can see that the fixed rate is higher than the floating rate. The bank has to pay a percent to the insurance company. And then finally, in the last year, the insurance company pays 2% back to the bank. So this is what we mean by fixed for floating rate swap. Okay, so it's called fixed for floating. This is the classic interest rate swap. They're not all done this way, but a large percentage of them are, because it's convenient. Okay, so you're basically trading cash flows with a counterparty in all swaps. Here, those payments are based on some specific rate of interest and the notional or principal amount involved. So like here, I think we assumed $1 million. Yeah, $1 million. So that's sometimes called the notional principal. So for example, when the bank owes 2% to the insurance company, that means 2% of $1 million, or $20,000. Now, of course, the bank is now receiving the floating rate, and they're hoping that rates are going up. That's the whole point of this. The insurance company thinks it's the other way around. They want the rates to drop so they can pay less to the bank. Okay, now here's a little side note, and this is kind of an interesting historical episode. The floating rate of interest in these types of securities, until fairly recently, was based on a rate called LIBOR, which stands for the London Interbank Offer Rate. And what this is all about was that at the end of each day, the British Bankers Association would contact the 16 largest banks in London and ask them what rate they charged for loans from the other banks. Okay, in other words, they borrow and lend among themselves sometimes when one of them is short of cash, for example, they do borrow and lend among themselves because they all have excellent credit ratings. The rate at which they charge each other is averaged out among these banks and gives us the so-called LIBOR rate, London Interbank Offer Rate. Now, what's interesting about this market is that they're not necessarily all denominated in dollars or pounds or whatever. This was a thriving market where there were LIBOR rates available for all the major currencies. There was a dollar LIBOR, there was a British pound LIBOR, there was a yen LIBOR, Swiss franc LIBOR, and they all had their own unique rates of interest. Sadly, and this, by the way, this market went back to the 1950s, and it worked well until, oh my God, there were some very serious scandals where certain banks, such as Barclays, were caught manipulating LIBOR rates to make money at the expense of their clients. And so, once it became clear how easy it was to manipulate this market, it was decided that every country should have its own version of LIBOR, but it will be implemented in those countries, not in London. So in the United States, we have something called SOFR, Secured Overnight Financing Rate, which takes the place of LIBOR. It was created by the Fed, as a matter of fact, to take the place of LIBOR. And what it refers to is the rate that is charged by one bank for a loan to another using what's called a repo or repurchase agreement. Now, what is that all about? Well, interesting. So here's the situation. Let's say Bank A needs to borrow, or it has a treasury bill worth $1 million. Okay. But they need money now. They need cash for some reason, but only for one day. All right. In other words, let's say for some reason there's a shortfall or somewhere they need to cover it. So here's what they'll do. They don't want to sell the treasury bill because this is something that's only going to last a day. So what they'll do is they'll approach Bank B and say, listen, here's what we can do with you. A borrows $1 million from B and provides the treasury bill to B as collateral. So it's a collateralized loan. And then what happens is A agrees in writing to buy it back the next day for, let's say, $1,500,000. So it's an agreement where I provide you, Bank B, with my treasury bill. You give me $1 million tomorrow. I'll give you $1,500,000. You give me my treasury bill back. So I'm in effect, selling my treasury bill to B and then buying it back or repurchasing it. So this is called a repurchase agreement. Okay. And the purpose of this is that I can borrow very cheaply because the loan is collateralized and because the time frame is very short. So whatever rate of interest that amounts to would now be called SOFR, SOFR, Secured Overnight Financing Rate. Okay. So it's a little different than LIBOR, but it serves the purpose. It can be used as a floating rate of interest in any derivatives contract. Wow. Okay. So it's any transaction in the repo market where banks can borrow overnight by using a treasury security as collateral. These rates are reported to the Fed, who then publish them. In fact, if we want to look at the Fed's website, yes, go ahead.
What are some instances where this would come into play, where the bank would need, let's say, a cash, uh, they need cash flow for in a
Oh, well,
hurry?
yeah, let's say, for example, they suddenly have a golden opportunity to lend money to one of their best clients, but they don't have the money on hand because they're still waiting to be repaid on another loan that they made out before. So they're expecting to be get the money back tomorrow, let's say, but it's too late by then. So they just need the money for one day. It's like an imbalance or mismatch between receiving money from borrowers and lending
Right.
it out to, lenders. So it's kind of like you and I. Let's say, remember back in the day when checks were everywhere, where we didn't have access to online bank accounts and stuff, and you would get a paycheck on Monday, but your rent is due on Friday. It's that kind of thing. You know
Got
what I
it.
mean?
Okay.
Like, yeah, it's like you've got this mismatch between when you owe money and when you're owed money. Or if somebody doesn't pay the bank back when they're supposed to, you could see how there could be a potential problem there.
And
So
this is
rather,
always the day after. It's always
it's almost
overnight.
always once in a
Okay.
while, it might be a few days, but usually it's just the one night.
Got it.
If you need something else, you'd probably do a different kind of loan. Yeah, it's pretty much understood. These are overnight loans. But anyway, these are the rates. Right now, it's at 4.35%. Now, that's on an annualized basis, of course. You're not going to pay that much money for a single night loan, but if you annualize it, it's going to be about 4.35%. So now this has only been around for a couple of years. They only actually created this because of the LIBOR scandal. Um, there's others as well. There's all kinds of rates now, but this is the SOFR. This is the one that's now officially recognized and used in contracts that involve a floating rate of interest, like swaps, for example. But anyway, now with that being said, let's these examples in my slides, by the way, still mention LIBOR because this happened fairly recently. But let's say that LIBOR is still being used. Now, LIBOR still exists. It's just not very commonly used in derivatives contracts because of the scandal. But let's just say we have a corporation issues debt, which they do all the time, $100 million worth of debt with the following terms and conditions. It's a 5-year bond that they're issuing, $1 million worth of these bonds. Oops, hold on. My computer's had a slow day today, I must say. The coupon rate, the interest that they're paying to their investors is LIBOR plus 2%. And now let's say they've issued this bond, they're starting to have second thoughts about it. They're thinking, maybe we shouldn't have done this because now we're pretty sure that rates are going up in the next 5 years. Why don't we do this? Let's go to a swap dealer and get into an arrangement where we trade the floating rate of interest to the dealer in exchange for a fixed rate of interest from the dealer. So let me show you the graph that would follow here. So here's the corporation. And the arrows are meant to indicate the direction of the cash flow. So the corporation here is paying LIBOR plus 2 to the bondholders, but now they're concerned that rates are going up. So they approach a dealer, say, listen, we'd like to get into an interest rate swap with you. And they negotiate. The corporation is paying 6% in exchange for LIBOR based on whatever the principal is. So what they've accomplished here is that, yes, they have to pay LIBOR plus 2 to the bondholders, but they're getting the LIBOR back from the dealer. So those LIBOR payments exactly offset each other. And the net effect or the net cost to the corporation is 2 and the 6, which means instead of paying LIBOR plus 2, they're now paying 8%, a fixed rate of interest. That way, if rates do go up like they're worried about, they don't have to pay any more interest. That would be a simple example of an interest rate swap. We have the corporation that wants to change their liability from floating to fixed. The dealer will take on any position. That's what they do. The dealer will take on this position with the corporation, and then they'll turn around and do the opposite with another corporation. What they'll do is they will find somebody else that they can trade fixed for floating. And what they'll do is they'll make a profit here because they'll offer to pay, let's say, 5.9% to another corporation in exchange for LIBOR. And so you can see now they've got LIBOR coming in, they've got it going out. 6 is coming in, 5.9 is going out, and they suddenly just made a 0.10% spread on the deal. So that's what they're doing there. They're getting in between the investors, and they're making a small profit, just like the bid-ask spreads with the foreign currencies. So otherwise, the swap dealer is left holding the bag. If interest rates do go up, the swap dealer will end up losing. So they're not in business to lose money or gamble. They will offset this with a swap with somebody else. So that at the end of the day, they have certain profits locked in. So for the next 5 years, they'll exchange these cash flows. Now, if the corporation, let's say LIBOR goes down, the corporation may say, well, maybe we shouldn't have done this, but they did eliminate all their interest rate risk. So that would be, they might say, well, that's fine. At least we got rid of our interest rate risk. Now, let's say that instead we have a pension fund now that owns a floating rate bond issued by a corporation. The notional is $1 million. It matures in 2 years and it pays LIBOR plus 3. So it's a floating rate bond. So why don't we jump ahead to the graph? So the pension fund is collecting, you can see the arrows coming up here, from the corporation. They own a bond that pays LIBOR plus 3. Well, they have decided that rates are probably going down. They would like to trade those cash flows for a fixed rate. So they trade LIBOR to a dealer in exchange for 7%. So that means that because these LIBORs offset each other, they're collecting 3% from this bond and another 7 from the dealer. So instead of getting LIBOR plus 3, they're locking in a return of 10%. Okay. So now that might prove to be a smart move, maybe not, but at least they've eliminated their interest rate risk. And that's, from their perspective, the most important thing. Now, by the way, these are interest rate swaps. We also have a lot of other types of swaps, which we'll get into in more detail later on. Well, here's one, currency swaps. This one's a little different because you're swapping liabilities or possibly assets that the typical case, the interest rates are fixed, but the currencies are different. So let's say a U.S. corporation wants to buy a 100,000 pound bond with a 6% coupon rate issued by a UK corporation because it's a very good coupon. Let's say that you're not going to get that kind of return in the United States. The problem, though, is that you're now exposed to exchange rate risk. And in this case, since you're collecting pounds, the thing that would cause you to lose money is a stronger dollar, because then each pound would be worth fewer dollars. So I'm collecting pounds for my investment. If the dollar gets stronger, I'll end up with less dollars as a result. So I'm nervous, but I don't want to sell this bond. What can I do? I can approach a dealer and say, listen, I would like to trade you these cash flows in exchange for dollar-denominated cash flows. So let's jump ahead a little bit to the graph. And you'll see, now this is a little bit messier because initially they trade the currencies with each other to buy the respective bonds. But during the lifetime of the swap, the corporation is collecting 6,000 pounds every year from the UK bond, which are now trading to the dealer in exchange for 9,500 US dollars. So they've traded pounds basically in effect for dollars. Now, at the end of the transaction, they have to swap the currencies back. But for all practical purposes, what you've effectively done is traded a pound bond for a dollar bond. And by doing so, you've eliminated your foreign exchange risk. Okay. This is a fairly popular structure. Between all the different swaps that are out there, the most common ones are interest rate and currency swaps. By the way, we'll have an entire week on just swaps. This is just like an introduction. We'll be able to get much more deeply into this in week 3, I think. In fact, all of these securities have their own, well, forwards and futures will be lumped together, but we'll have 1 week of forwards and futures, 1 week of swaps, 1 week of options, and then we can dive into pricing issues, hedging issues, and things like that. Now, by the way, sometimes if you manage this correctly, what will happen is a corporation may decide that it makes sense to borrow money in a country with cheaper interest rates. Like here, for example, the corporation can borrow in the United States for, let's see. Oh, they have the ability to borrow in the United States for 1.5%, but only 0.5% in Japan because interest rates are lower there. So the corporation wants to lower its borrowing costs. So what they're thinking about doing is issuing a bond in Japan where they would pay the 0.5% in yen rather than 1.5% in dollars. And then what they can do, since they've already borrowed in Japan, they owe 0.5% in yen. And what they're going to do is collect yen from the dealer and pay back dollars to the dealer. So in other words, the net effect here is that you're borrowing at 1% in dollars. So you've actually saved some interest. And if you borrowed in the United States, in the first place, it would have cost you 1.5%. Now you're getting away with 1%.
Doesn't the currency rate play a role here?
Well,
Exchange rate, excuse me.
it does because you're trading a bond. You're actually trading 2 bonds. But in the beginning, we're assuming 100 to 1, 100 yen to a dollar to keep it simple. But yes, you could find yourself with a slightly different result if the dollar and the pound yen fluctuate. But because you start out by paying 100,000 yen to the dealer for $1 million, and then you trade them back. But usually, like in a country like this, Japan usually tries very hard to keep the yen from appreciating. So there's not going to be a whole lot of risk of this happening. But now, some people claim that this is kind of, it doesn't make a whole lot of sense because the dealer may not be willing to go along with this. The interest rates, like for example, here it's only 1 versus 0.5%. It depends on the relative size of the interest rates in the 2 countries, but it's still theoretically possible to save some interest by borrowing in the low interest rate country and then swapping out the proceeds for the high interest rate cards. Oh my God. Huh. There's just a weird noise over here somewhere. I was just wondering what it was. Huh. All right, well, I don't see anything going wrong over here, but there's just a weird noise for a minute there. Okay, well, anyway. Now, I'll tell you. Now, by the way, I forgot to mention this right up front. This is a very, very long class. We've got to have a break somewhere in here, right? So why don't we knock it off here for a bit? It's about 10 of 8. Why don't we come back at, let's say, What do you think? How long do you think that you need to eat something? Maybe 8:15? How does that sound? And then what I'd like to do is spend the last few minutes on options. This is by far the most interesting but complicated type of derivative. So we'll just briefly run through the key properties of options. But we don't want to do this in an empty stomach, do we? So let's knock it off. We'll come back in a bit. I'm going to actually pause the recording so that there isn't a huge amount of blank space in that recording. And so when we get back, I'll turn it back on and then we'll wrap it up with our just very brief introduction to options. Options will actually take up most of our attention throughout the rest of the course after we're through with forwards, futures, and swaps, because they're so powerful and so flexible and so complicated that it will require several weeks to analyze them properly. So this is like a coming attraction of a large percentage of the rest of the course. So I think you'll find them to be extremely exciting if you're not familiar with options already. So we'll stop here. We'll come back about quarter after, and then we'll carry on with options. Okay. All right. See you in a bit. Yeah. I think we're ready to wrap it up with our discussion about options. So again, this is just a brief introduction. We'll be spending a lot of time with options in this course. So what really separates options from the rest of them is the idea that you're given the ability to do something, but you're never given a legal obligation to do something. In other words, you have the right to do something, but never the obligation. Whereas with a forward contract, you're entering into a legally binding agreement. You must do whatever you promised to do. With a futures contract, it's the same thing. Even though you can offset your position, you still have a legally binding contract. A swap is equivalent, as it turns out, we'll see later on, to a portfolio of forward contracts. So the first three of these derivatives are very, very similar to each other. This one really stands alone. And of course, by the way, the name option comes from the fact that you're given the right to do something, but you're not ever required to do so. Now, options, just like forward contracts, give you the right to either buy or sell some asset. And now, of course, this comes at a cost. The one other thing that's different about options and forwards, futures, and swaps is that here you actually have to buy it. Okay, in other words, you're not just entering into an agreement, you actually have to buy an option. And they can be expensive, although if you choose wisely, you can find options that are not terribly expensive. You have all kinds of choices available to you in the marketplace, but you do have to pay for these. And so that is one of the only real drawbacks to options. So in effect, what you're paying for is the right to change your mind. Now, we can characterize options in several important ways. First of all, what is the underlying asset? What is it that you have the right to buy or sell? Now, it turns out that initially, when options trading really started taking off in the United States in the early 70s, for the most part, options were only available on stocks. And of course, that's changed since then. We have all kinds of options available. You can buy options on anything you can imagine, really, like interest rates or currencies or equities, equity indexes like the Dow Jones, precious metals like gold and silver. Now, here's an interesting twist. You can buy an option on a futures contract. In other words, it's a derivative of a derivative. So, and there's reasons why you might want to do that, by the way. In fact, once this idea came about, once futures options started to become available, it became clear that they had so many advantages that at this point in time, most options are actually written on futures contracts, where you have the right then to buy some other underlying security through a futures contract. So they're called futures options. Now, you can actually, believe it or not, also buy an option on a swap, and these are called swaptions. There's options on forward contracts, which are called forward options. And then we also have options on other options, which are called compound options. So, the complexity can get very intense very quickly with options. And we'll discuss some of these as we go along. But the basic types, the ones that we first saw in the marketplace, are the ones we're discussing now. So the second characteristic, which uniquely identifies an option, is the price at which you can buy or sell the underlying asset. And in the options markets, this is known as either the strike price or the exercise price. Okay, so with the forward contract, that price is sometimes called either the forward price or the delivery price. Futures markets, it's called the futures price. And with swaps, you're just basically trading cash flows based on the difference between, let's say, a fixed and a floating exchange rate. But here, the price at which you can buy an asset or sell it is called either the strike or the exercise price. Now, the maturity is how long until the option expires. It doesn't last forever. All derivative securities have a fixed lifetime. For example, with a forward contract, often maturities are 3 months or 6 months or a year. That means that's how long it'll be before you actually buy or sell the underlying asset. Right here, this refers to how long until the maturity date of the option, at which time you either use it or buy or sell the asset, or else you let it expire. Now, the option that gives you the right to buy something is known as a call. The option that gives you the right to sell something is known as a put. Now, I do not know the origin of these names. It's a little different than what we've been seeing up to this point, but just remember, call means you can buy and put means you can sell. Also, as far as the exercising of, or buying of the underlying asset or selling it, there are two basic types of options. The European style means you have to wait to the maturity date to make a decision. Should I or should I not buy or sell the underlying asset? So you only have one opportunity to make your decision. Do I buy or sell or do I not? Whereas with the American options, every day until the maturity date, you can decide if you want to buy or sell the underlying asset. So of course, that means the American style options are more powerful, give us more flexibility, but because of that, they're also more expensive. And again, we'll discuss this in a later chapter. There are others too, but those are the basic types. Those are the standard ones. Now, the type of option often depends on what the underlying asset is. For example, interest rate options are typically European style, but stock options or equity options are usually American style. That depends on a lot of other factors, but if you go into the market, you'll find that certain types of options tend to be European and others tend to be American style. All right, now the premium. Now, this is the price that you have to pay to buy an option. And this is like I said before, I think this is the part where all the rocket science gets involved because pricing options is a horrifically complicated activity. And in fact, we'll talk about this in a later chapter, but it took until 1973 to come up with a model that enables investors to determine the appropriate price for a European option. That model was called the Black-Scholes model. And we'll analyze that in great detail. But what's interesting about this is that Fisher Black and Myron Scholes were a couple of academics. Fisher Black was at Harvard, I think. No, MIT, sorry. Myron Scholes was at Stanford, and then they had another academic join them after they started this project, Robert Merton at Harvard. And they thought, they came up with this idea, why don't we write a paper in which we explain the proper procedure for pricing a European option? They had no idea themselves how important this paper would prove to be. It revolutionized the entire industry because prior to that, it wasn't possible or easy to figure out the appropriate price for an option. And so because of that, there's very little option trading in the United States, at least. Once this paper came out, it blew the doors off. And so suddenly the volume of trading went to the roof. And so eventually they were awarded the Nobel Prize in economics for their efforts. That shows you how important this proved to be, the Nobel Prize in economics. Okay, so now what I'd like to do is show you some actual options. If you go to finance.yahoo.com, I didn't mention this before, but they do have option prices on here, though they're all equity options. Let's go to Apple, for example. And you notice now we looked at this earlier. You can see the price of Apple stock in the recent history. By the way, if you're interested, they have lots of other information here as well. Like, for example, you can get the history of Apple stock prices if you're doing research of some kind. And you can typically download this into an Excel spreadsheet. But they also have the financial statements. They have the income statement, they have the balance sheet, they have the cash flow. If you want to analyze this properly and decide if you should buy it or not, all of that is here. But what we're looking at today is the options. And if you look here, you see there is a link to the options written on Apple stock. Now, unfortunately, this only gives us a single day worth of prices. If you want more than that, you have to pay for it. But it gives you an opportunity to look at these different options. What happened here? Oh, no, it's there. Sorry, I wasn't paying attention. There it is. Okay, so what I'd like to point your attention to is a few key details here. First of all, right here is the maturity date for these options. Now, that's tomorrow. So these options are about to expire tomorrow. So the owners will have to decide, do they want to exercise them or not? You can see there's other dates available here. Why don't we look ahead at, let's say, May 16th? And you'll notice that the calls are on top and the puts are on the bottom. And what do we see here? We see all these different options. What separates them all is their strike price. So this one on top gives us the right to buy a share of Apple stock for $100. Now you can see it's actually worth $245.83. So this option is rather valuable. In fact, the price at the moment is $147.30. As I increase the strike price, the option becomes cheaper. For example, if I have one with a strike of 250, that one only will cost me $10.05. And if I keep raising the strike price, the option becomes less valuable. And you'll notice that eventually I'll reach the point where, like here, this one is only 14 cents. So you can have any number of different options. This one is 147.30. This one is 14 cents. And we have everything in between. The blue ones, by the way, are the ones where the strike price is lower than the stock price. And that means, like, even this one, there's a difference of 83 cents between the strike price and the market price. If I exercise this option, that will result in a payment to me, a payoff rather, of 83 cents. But in order to buy this thing, I have to put up $12.85. So we'll discover when we start looking at this in more detail that what it is that determines this price is first whether the option is a call or a put. What is the relationship between the strike price and the stock price? The level of interest rates in the economy, and a value called volatility, which we'll see later on, which basically refers to the risk of the stock. And down here, if you go further down, you see the puts are down here. The puts are the ones that give you the right to sell. So the low strikes are not very valuable at all. These are the ones that let me sell the stock at a very high price. And so naturally enough, their prices are much higher. So, this is, for now, that's enough discussion. The only other thing I'd like you to notice is that the further out into the future we're looking, the higher the prices will be. Because the more time we have until the maturity date, the more likelihood there is that the stock price will continue to rise and increase our profits. So the longer maturity options are more expensive, all other things being equal, than the short maturity options. In fact, maybe we could do a little bit of a comparison here. If we go back to February 21st, we have, let's look at let's say the 250 strike option. It's worth 12 cents. Because the chances of it going up to 250 by tomorrow are not very high. Tomorrow's the expiration date. It would have to go up by almost $5 for us to have a profit. But if you look at, let's say, May, for strike of 250, the price is $10.05. Okay, and that's because chances of the stock price going up above 250 between now and May are quite high. So what you're paying for is the time itself, the time over which the stock price could continue to rise and more profits go into your pocket. Okay, so again, we'll tie all this together and we'll show how these different factors affect the price of the option. We'll also introduce the Black-Scholes model, and we'll actually calculate Black-Scholes prices using Excel. All right, but that's several weeks down the road. In the meantime, let's see, what else do we have here? Oh, by the way, here's an interesting twist with options. With an option, if you own an option, there is a limit to how much you can lose. You're limited to how much you paid for it. There's no maximum profit. So that imbalance between potential losses and gains is one of the things you're paying for when you buy an option. Okay. You don't see that in too many places. Limited loss potential, unlimited profit potential. That's very rare. Now, also later, well, all right, well, let's see. All right, I'll tell you what. So that's kind of it for this overview. What I'd like to do now is just briefly show you what you can look forward to next week. Let me find Brightspace. Look at this. I got so much stuff open here. Let me just close some of these down. The computer doesn't react well to having a lot of windows open. Here we go. Oh, by the way, don't forget there's a very brief assignment here. It won't take you too long to do this. But week 2, we're going to turn our attention to forwards and futures. We're going to treat them as a single. We're going to treat them all at once in session 2 because of the similarities between them. But we're going to take a more deep look at forwards and futures. And we're also going to not only look at their properties, we're going to learn how to determine forward prices. In other words, earlier we had an example where we were buying foreign exchange in the forward market, but we never really explained where those prices are actually coming from. So we'll focus more of our attention next week on pricing issues. And oh, this is interesting. I just realized I see some blanks in here. I think what you have to do here is download this. You notice how I was writing on the screen? I have a tablet here. One of the annoying things, though, about this is that I think if you save this as a PDF file, it doesn't pick up on the handwriting for some reason. So we have to be careful here. Let me just download this real fast. Oh, it's taking sweet time. Oh, God, what's going on? Here it is. Okay. Oh, yeah, that's what's going on. There's a lot of handwriting here. I must add some extra examples last time we ran this class. So, yes, we're going to see a lot of discussion here about pricing and look at more examples of contracts that trade on the Chicago Mercantile Exchange. We're going to have a full example of marking to market, so you can see how this is actually done with a numerical example. The theoretical relationship between the futures and spot prices. Oh, all kinds of interesting things. Hedging hedging our risk with futures contracts. A lot of fun things. All right, very good. There's some statistics there, by the way, and we'll review if people have forgotten, for example, what correlation means, we'll review as we go along. Okay, but you can't be helped that some of this is based on statistics. So, but you'll be all set. Don't worry about that. All right. So I think we're kind of done here. I didn't realize we were so close to the end, but so next week we'll be looking at section 2, and we'll be taking a much deeper look at forwards and futures. The following week will be swaps, and then after that, almost all of our attention will be on options. Okay. All right. So I guess oh, I'm sorry, I didn't see somebody's hand there.
I just had a really quick question going back to
Sure.
like the calls and puts. Are those
Yes.
Is the value affected by things like earnings or like CPI prints or anything like economic that comes out?
Only indirectly through the price of the underlying asset.
Oh, gotcha. Okay.
Right. So if all of those things cause, let's say, the stock price to go up, that will cause the option price to go up. If it's a call, it'll go down if it's a put.
Gotcha.
So yeah, so if you like, if you know what the stock is worth, or if you know how it got to that point, the option price will increase, and you'll see how we determine that too. It's not by, let's say the stock price goes up by $1, the option will go up, the call at least will go up by less than $1, and we'll see how that's determined. If the price goes down, the put price will go up by, again, less than $1.
Gotcha. Thank you.
All right, you're welcome. All right, so is there anything else?
Yes. How do we submit the assignment?
Oh, you know what you can do? You can type it up in Word, you can write it out by hand. Now, this is what I recommend you do. This has been my experience. If you have a proper scanner, go ahead and use it. Scan it back to me by email. If not, it's been my experience that there's an app on my phone called Adobe Scan, which does a really good job scanning documents. But I'm guessing you probably have a proper scanner/printer in your office that you can use. So now somewhere down the road, our assignments will be done in Excel. And then, of course, then you can just do your work in Excel and send a spreadsheet directly to me. But when you're using Word, especially if there's drawings involved or there's equations or whatever the case may be, you can just literally just scan it and email it back to me. My email address is in the syllabus, but I will write it on the screen anyway. It is.
Yeah, we don't have the syllabus yet.
Oh, that's right. I forgot. That was so weird. All right.
Well, you had
And then
emailed us the Zoom link, so is it the same email address?
that's a good point. Yes, it is. Good. That's a very good observation. Yeah, just return it back to me. You can forward it or whatever it takes. And try to have it done within a week or so. But
Would you
because I
be
know
able to send us the syllabus? Just email us the syllabus.
you see now that's a good question. In the past, that's exactly what I would have done, but they told me just like yesterday not to do that. They want it to come from the website for some reason.
Yeah.
But then of course, as you pointed out to me tonight, it's not available in your none of you can see it, right? It's not just Alex, right? None of you can actually did you see
Yeah,
what I
no,
did
I
Yeah, I
can't
before?
see
can't
it.
see it.
Okay, well, I better let them know because that means that technologists have to get involved. And because technology is not my thing at all. So during the daytime though, I have one advantage though. I teach college students all day long. They know the technology, and so I just can ask them. But when I'm
If
at home,
you're if you put your information into these different content modules, so week 1, 2, etc., you may be able to just upload the syllabus into, let's say, week 1,
Yeah,
and then
that's
we
what
can
my
all access it.
previous instructors have done. They put it in the
Yeah.
content.
oh really? Okay. So since we just started doing this new way of, I wasn't even aware. Well, first, I wasn't aware this was going to be a problem, and secondly, I didn't know that it was possible to do that. So, and all of this just yesterday, I was informed about some of this, and so I will make a note to myself again, not just to call the school, but to find out, is it possible to move that information into one of the other folders? It was up to me. That's fine. Why would that be a problem? But I don't really understand why it has to be done this way. But that's what they told us. So I'll send it out, and I'll let you know as soon as they let me know. Now, because this could cause issues with your delivering or returning your work. So today's Thursday. So we'll tentatively say that it should be ready by not this weekend, but the following weekend. Let's say that you should always have, let's say, 10 days to get this thing done. But if this proves to be a problem, I might have to give you more time for that. But so I'll find out what I can. You know, all these years we've been doing this for quite a while, and all of a sudden this year they said, no, 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 you got to do the syllabus this way. So anyway, but you're right. At least you do have my email address. So also, if you really are interested in getting that book, it's a really good book. It's really like the kind of thing you should have in your office at work for reference. And let me just show it to you one more time, because now that I know that you can't see the syllabus, let me remind you. Hold on. I'll just go back to Amazon and show you which book it is. Maybe, who knows, maybe your company will pay for it. I used to work at companies where they would buy books, but only if you left it in the office. In other words, you can't actually take it home, but they'll pay for it. There it is. In fact, you know what I could do? I should be able to put the link. And I did mention earlier, now this, I was expecting this to be a lot more expensive. They didn't used to have paperback versions. They used to only have hard covers. So it was like 200 and something dollars. But if you get a slightly older version, it's not a problem because, like I was saying before, it's not going to, or it hasn't changed. Oh boy, look at the length of that link. What happens if you click that on? Oh, here it comes. All right, so be careful. I think this link will disappear after we stop tonight. So if you want, you can click that on and open it up in your own browser.
But
And
that
then you
book
can,
won't arrive until March 21st.
oh my God, you're right. Oh my, I didn't even notice that. What is going on with this? That's really frustrating. Huh. Well, I mean, the thing is, you don't have to have it for this class. Everything that you need should theoretically be in those notes. So, God, that is, I can't get over that.
Mm, I
Sure.
was over in Amazon too, and I was able to get this one because it gets fast.
Oh,
Is that a good one?
that
If
looks,
that's a global edition.
okay. That should do it. The only thing is obviously the page numbers will be different if you want to look up certain topics, but it's all in there. You should be fine.
Yeah, because the other one comes sometimes from India. That's why it comes around March 21st.
Okay.
But
Yeah,
from the US, so tonight.
okay.
You got it.
Nice. Jesus. Now, oh, see, now this one says Global Edition.
Yeah,
That's the
that
one you got, right?
yeah.
And for, oh, you know what? Why don't you get that one then? It's only 55
Mm-hmm.
and it'll arrive, well, March 6th is still kind of a ways
No,
off, but
6. It comes 26. It should come to my
oh, no, you're right. It says free delivery February 27th through March 4th. Okay, so I'll send you this link. I'll send everyone this link. Thank you for letting me know that. So the global edition apparently is the one to buy, and it's still not that expensive. But this is up to you. You know, it's your decision. If you don't think you'll ever need this, you might not want to buy it. But I think that you'll find that it has so much useful information in it. Um, I mean, it's a whopper of a book. It's like 900 and something pages because he's trying to cover everything, absolutely everything. But all my notes are based on this book. So yeah, there's so many in the market. But this is the big one. This is the important one. Everybody knows this book. All right, so I guess there's nothing else for us to do tonight. So I'll see you all next Thursday. But now, one other thing I just want to mention, I sent you the link by email and you obviously got it. I'm pretty sure that that link will work for the entire semester. So I would like to send you a link every week just in case, but if it doesn't happen, I'm pretty sure that you can use the same link every week. like I said, technology is not my thing. So that way, if I forget, I normally send one out every week, and I'm going to do that anyway if I remember. But if I forget, just you can just use the old links.
You can bookmark
Okay.
if you like also that link. You just click on it and get into
Really?
the meeting.
No kidding. I didn't know about that either. Okay, good. I'm glad you mentioned that. All right. So that way there should never be a time when you can't get into the class. Um, all right. So, okay. I'll see you all next week then. Oh, and one more thing. Don't forget the recording will be available on my YouTube channel sometime tonight or tomorrow. It takes a while to process it, but it'll be available very, very soon if you want to look at it. All right. Excellent. All right. See you all next time.
Thank you.
All right. Good night.
Good night.
Okay.